welcome to Off the Books, where we surf the uncharted waters of accounting, finance, risk, and wherever else the waves take us. This episode is brought to you by Workiva, the risk reporting and compliance platform that simplifies your complex work and keeps you warm during a polar vortex. Check it out at workiva.com/podcast. My name is Steve Soder, accounting enthusiast and Diet Coke aficionado. I'm looking forward to debating a great conversation today, and I'm very glad to have you hanging 10 with us. I'm also very happy to have Catherine Sy joining me. Catherine, can you please tell the fine folks who you are?
I'm not an accountant or Diet Coke aficionado, but I like asking questions, learning new things, and writing about them later, so I'm here to learn.
Well, thank you, Catherine. We won't hold that against you. There's been a lot of attention about SPACs over the last couple of years, and for some background, a SPAC,
which is a special purpose acquisition company.
That's right, is what is known as a blank check company that goes public through an IPO and raises a bunch of capital for the express purpose of buying another company, which is usually referred to as a reverse merger or a de-SPAC. SPACs are often seen as a shortcut for that other company to go public, allowing them to circumvent some of the steps involved in a traditional IPO. But the SEC might be changing all of that.
That's right, Steve. SEC Chair Gensler gave a speech recently with some of his strongest language yet about the imbalance between a SPAC taking a company public and what the traditional IPO process would be for that same company. So we brought in Mike Koch, Securities Counsel and Partner at Wilson Sonsini, who is no stranger to the capital markets, and he'll break it down for us. All right, so maybe we can set the stage first. Mike, how would you describe a SPAC if you could do it in like 100 words or less?
Well, I mean, basically a SPAC is a means to collect a pot of money for a group of sponsors who support that SPAC to sell the idea that they're going to go find an operating company that they can acquire. And so what their initial step is they take their SPAC and an IPO and sell shares to the public, usually at $10 a share. And once the IPO is done, you have a blank check company that's trading on the exchanges and is a reporting company. And it usually has a timeline to complete an acquisition of an operating company. And that timeline runs, 18 months, sometimes 2 years, etc.
And they've been around a long time, right?
Yeah, they've been around about, I think, 20 years or so. And so in the last basically 18 months or 2 years, we've just seen an explosion of popularity.
Mike, one of the things that I think is interesting is just the differences between a traditional IPO and the SPAC process that you just described, especially given the speech by SEC Chair Gensler that we've been talking about. Could you summarize maybe the major differences between the SPAC process and a traditional IPO?
I think a few key differences are, and this is, alluded to in Gensler's speech, when the SPAC does find its target, it basically, because the SPAC is already a publicly registered trading, blank check company, it basically publishes essentially a deck, and an 8K, and announces the deal and has essentially an investor call to say, we found this target. We essentially want to take this target public by merging it with us. And, here we are. Wait to see some more information, right? And so once all that's announced, the market can react and see how, it's going to, whether it likes the deal or not. And, one of the big challenges is there's a further disclosure document that needs to be done with the SEC to make sure that the deal can get closed. But oftentimes between the announcement of the deal and filing of that disclosure document, there could be numerous months. And so I think what the SEC is getting at, or Chairman Gensler is getting at, is, there's a sort of a time period where maybe the public investors in the SPAC don't have the full panoply of information that they need to see about the target. And so you have trading going on in the SPAC, and that's one of the limitations of the structure.
Which is a lot different. Again, I mean, in a traditional IPO, golly, there's very little that you can say, and everybody's paranoid, right? Don't tell your neighbor, don't tell your family, don't tell anybody we're doing this, right?
That's right. That's absolutely right. And I think another big difference is, the process with the underwriters. So you have the company counsel, the underwriters counsel, the auditors, all that stuff. All that process in a traditional IPO is all happening on the front end, right? In the SPAC that I just described, that process, some of it's happening in the front end, some of it's happening after the announcement of the deal when you're drafting the disclosure document. And so what I've heard and what I've heard the SEC say is there's a real question of confidence in the gatekeepers, because you don't, instead of underwriters, you're kind of relying on the sponsors and their counsel to do the diligence. And, if you look at the incentives that people have, if the sponsors are really desperate to get a deal done, are they going to be doing all the right level of due diligence? At least that's what one of the theories is as to, what the risks are on those transactions.
And it seemed like Gensler was really trying to hit at that in some of his remarks. I was wondering if you had if anything stuck out to you from Gensler's speech.
Yeah, I think that gatekeeper role was a huge one, and when he had an implication of looking at the timing, this disparate timing that we just talked about. That one will be, it'll be tough to see how the SEC manages that if they're going to change the rules. They have their work cut out for them because it is a merger and it is just a fundamentally different process. It would really kind of gum up the works if, you had to have that disclosure document done by the time you announced your merger. And it just creates all sorts of practical, challenges, like how do you, it's already hard enough to keep a deal under wraps. How do you do it when you're adding months to be able to do your disclosure? But we'll see how the SEC deals with that. I also think sort of he's touched upon in the comments is, a lot of times for the traditional IPO, the companies have spent often months and months getting ready to be a public company. And what we find in the market is for the SPACs, oftentimes the private operating companies, they sort of get an offer across the transom and they just run with it. And so they may not have the level of preparation that has been done. And that goes to, the company. Does it have the controls? Does it have the financial reporting in place? Are the accountants ready, et cetera?
It's interesting you bring up the timing. I mean, I have several colleagues who have been part of these SPAC mergers, and the speed and the ferocity, if that's a word I could use here, that's required to pull that off successfully is it's astonishing. I mean, I've been a part of an IPO, and I mean, my goodness, that thing was in place, or we were preparing for that for years. I mean, for years, literally, right? Just to think that you could do that almost overnight. Of course, maybe nothing's overnight, but almost just as fast anyway, at least in the world of financial reporting. That seems very frightening to me, to be honest.
And I think the SEC, to that point, I think the SEC in their review process has tried to slow things down a little bit. And I've seen some de-SPAC transactions that had significant issues with the SEC that, ended up being in review for many, many months.
I've got to imagine that the SPAC sponsors, of course, need some time to at least understand what the deal is and do we want to participate. And
that's right.
And that, of course, takes some time and actually is going to require some disclosure.
Yeah. Absolutely. No, you're spot on that. So,
well, one question, Mike, to ask. I mean, we know that it's possible that a SPAC will not find a target within the required time frame that you alluded to earlier and would have to dissolve. But I've heard, at least anecdotally, that there is way too much money in some cases for the SPAC sponsors to not find a target. Do you see that play out in practice? Not, of course, putting you on the spot to disclose anything you otherwise wouldn't, but I mean, anecdotally, do you think that's a problem?
Fundamentally, I don't think, I think the market is going to be aligned. It certainly could be a problem, and you could get a sponsor who's, let's say, acting desperate and will take maybe a lesser operating company out. But there are a couple of ways to work against that. One is many of these deals to get done. The private operating company will almost virtually every deal, agree to a minimum cash closing position. And to support that cash position, the market has moved to basically PIPE investors. So private investors will sign up to the deal ahead of time. And that way, if the deal is somehow unpopular, and there's a lot of redemptions in the deal because the SPAC IPO investors can redeem their funds if they don't like a deal. The PIPE investors will provide the money to support it. And what we found in the market is that the PIPE investors are really a validation of the valuation, and it really controls that aspect of it. Because if you don't have reputable PIPE investors and you're moving forward with a deal, you may find yourself in a situation where, you're getting to the finish line, there's a ton of redemptions, and then the share price of the SPAC starts to, fall below the $10.
Well, that's a good note to me and Catherine for 2022 to maybe rethink our plans to make a quick buck by going in on a really crappy SPAC merger. So we'll need to take that one back to the drawing board, Catherine.
Steve, let's take a time out here because Mike mentioned PIPE investors, which my Google machine says stands for Private Investment in Public Equity. So this is money that big-time investors are putting into a public company like a SPAC. And Steve, could you recap what Mike was saying? I'm asking for a friend.
Sure. Yeah, asking for a friend. Well, the thing with the SPAC is that when it goes public as a blank check company and everybody buys in at, let's say, $10 a share, which is what Mike mentioned, they have the right to get their money back if they don't like the company that the SPAC acquires. So when a SPAC finds a company that it wants to buy, there is, of course, a price at which that company will sell, but the SPAC isn't sure, actually, if it's going to have enough of its original investors who will stay along for the ride and keep their money in the SPAC to actually buy that company at that price. So the SPAC finds private investors, and as you mentioned, Mike called it a PIPE investment, which is a little different from what you might smoke or snowboard in Colorado over the weekend. Well, these PIPE investors agree to put their money in almost like a backstop in case more money is needed to buy the company, because all the other individual and initial SPAC investors might pull out. And what Mike was saying is that if it's a really crappy company, then not only will the original SPAC investors pull their money out, but the SPAC is likely going to have a hard time finding the PIPE investors to begin with.
Okay, thanks, Steve. I'm not sure what you're doing on your weekends in Colorado with PIPE investors, but we need to take a quick break, and we'll be right back with more SPAC and Mike Koch from Wilson Sonsini.
This episode of Off the Books is brought to you by Workiva. Do you remember 1985? I do not, as I was not alive, dear listener. It was a year of new Coke and hair metal. It was also the year the original Super Mario Bros. Came out, and it was the year that Microsoft Excel was released. Video games have evolved really, really dramatically since 1985, and so has business, but Excel is roughly the same. Maybe you are mentally connecting dots here. My point is this: why are you still using software from 1985 for businesses staffed and created by people born after that? It just don't make sense. Introducing Workiva. With a familiar interface, it feels like Excel, but is so much more. Centralize all your vital reporting and risk data in one spot and get rid of those terrible shared drives. This gives you more time to do important stuff, like drink new Coke and play video games and listen to Motley Crue. Yes, Workiva, it is the real thing. That's workiva.com/podcast.
We are back after Catherine's quick pipe break, talking SPACs with Mike Koch from Wilson Sonsini.
What conversations do you hope SPACs and SPAC targets are having right now before they go public?
Yeah, I hope they're spending the time, both sides, on really, thinking about the quality of what they're going to offer and doing that due diligence. And I think they are overall. I see that in the market. I think that's really sort of key. It's like making sure, and to the point we were just talking about, making sure there's a good match and that it's going to be able to, succeed and trade. I think we haven't sort of dove into the projections point, which, Gensler talked about, but to the diligence and the projections, I'm sure you've all seen the headlines of the SEC investigating certain of these companies for their projections. As a reminder, in an IPO, we never use projections. It's just totally taboo. You don't have any protection under the securities laws, so you don't want to do it. In these de-SPAC deals, they often will use projections and put them in that deck we talked about. And it's because the SPAC's already a public company and it's being done with a merger, that's how they sort of, the structure works that way. But, if you're giving projections, they've got to be well substantiated projections. And where the SEC has been investigating some of these cases has been where essentially, the company just sort of threw together projections, had many different models, only showed the best model, so they cherry picked the best model. And that's led to a huge amount of, claims of fraud, et cetera.
Yeah, some of those projections are beyond absurd. Like, in 5 years, we're going to be bigger than Google. I mean, it's just like, how does that even happen?
Right. Yeah.
So, Mike, with potentially more regulation coming, and it seems as though Chair Gensler has all but indicated that something will be coming, do you anticipate a drop in the interest of private companies going public through the SPAC process as opposed to the traditional IPO?
I think there will be a drop, and I think, but I don't think it'll be off the cliff. So I think the SPACs will continue to survive and offer an alternative for some companies who maybe can't or don't want to go out in a traditional IPO. So I don't have a crystal ball, but I would suspect with more regulation and sort of smoothing out the differences in timing between the traditional IPO and the SPAC, I think we're going to probably see, a decline in the use of SPACs, but not a totally wiping out of the tool. So.
Well, Gensler also called out the fact that there are some SPACs that have celebrity endorsements. Yeah. Do you expect any sort of drop in that at all?
I probably do, because if the SPACs aren't able to produce these deals as quickly and lucratively as before, then maybe it reorients the industry to more of the professional financial industry rather than this celebrity craze. So, but we'll have to see.
So, Mike, for our closing question of the day, which is always a little bit humorous, and we'll put you on the spot here. And on the subject of celebrity endorsements, if there was a celebrity out there who, based on his or her support for the deal alone, could get you to buy into a SPAC, what celebrity would that need to be?
Oh, wow. I think for me it'd be Snoop Dogg. Which I guess would probably be a cannabis SPAC, right?
Undoubtedly.
Yes.
I love it. Catherine, how about you?
Oh, I'm going where the money is. I'm going to say a Kardashian. Any of them will probably do.
Okay, that makes sense.
What do you think, Steve?
You know what? I'm going to go for Tom Hanks. A lot of volatility in SPACs right now. Tom Hanks seems to be sort of a stabilizing presence. Perhaps that's just what the SPAC market needs right now.
There you go.
I wanted to sneak in one question because I'm just curious, but I was just looking at SPAC research. They're saying now there's 607 SPAC IPOs this year. Are there even 607 viable targets for these SPACs to merge with?
Probably not. I would say not.
So why do people keep forming them? We need to take a break or something, I think.
Yeah, it's really all about the investors. They're going to get their money back, and if the SPAC finds something and they don't like the deal, then they'll get their money back, but they still keep the warrant. And so it's kind of given where we've been in these last couple of years, where it's hard to deploy your cash, and there's a lot of cash sloshing around the system. It's like, well, okay, I'll just take a chance with the SPAC. It's just my money should be safe, and if it doesn't work out, so be it. And maybe I have a warrant that turns into some value. If it doesn't work out, I get my money back. But I'll take the chance. So.
Well, and it occurs to me that, again, back to the point of celebrity endorsements or whatever, seems like somebody could kind of just ride that announcement thinking that, hey, this celebrity is going to bring some cachet or some notoriety or whatever, but I intend to sell, maybe the price of the SPAC before the merger goes up, and then I just intend to sell before that, and I've made a little bit of money, and then I still have this warrant, so, hey, what do I care whether or not they find a target?
Exactly. Yeah, and I think that does happen, so.
Catherine, well, that was our conversation with Mike Koch. Did he demystify SPACs and maybe explain some of the SEC scrutiny?
Yeah, I'm anxious to see what the SEC has in store for SPACs and pipes and IPOs, FWIW. How about for you, Steve?
Well, yeah, for me too. It cleared up a lot of things. And really, especially the mechanics of where all the money comes from, including the money from the pipe investment, which has now become our new favorite term for SPAC investments and weekends in Colorado. I'll say, though, our second most favorite term is, of course, thanks, with a big thanks to Mike Koch, Securities Counsel and partner of Wilson Sonsini.
Agreed, and big thanks to you, dear listener, for surfing along with us. I'm Catherine Sy, that was Steve Soder, and this has been Off the Books presented by Workiva. Please subscribe, leave a podcast review, tell your buddies if you liked the show, and feel free to drop us a line at offthebooks@workiva.com. Surf's up, and we'll see you on the next wave.